Hey, this is Sasha. Thanks for joining me in today's video. And what I want to do today is share with you the pros and cons of a longer duration, or let's say 40+ day Iron Condor, than maybe a 10-day Iron Condor. So stay tuned. I'm going to share with you some insight on what the big differences are as far as setting these things up in this video. All right, so a lot of people, when they look at Iron Condors, they think of it, hey, they're all the same, right? They're all the same. There's no big difference. But the reality is there's a huge difference when it comes to Iron Condors, because most people, when they say, hey, how do I set an Iron Condor up? They don't really think about and they don't really consider the duration. The duration is very important when you're looking at setting up Iron Condors, because if you don't have duration, you don't know what's going to be a bigger issue or problem or risk. So in this episode, that's what we're going to do. We're going to cover, I've got a few Iron Condors set up. We're going to cover these different setups. By the way, if you want to learn a lot more about Iron Condors, these kinds of things, options, check out the free mini course on option trading in my freebies section. When you go into the website at tradersfly.com, the link will be in the description below probably. And then what you could also do there is check out some other great freebies there. You can also check out the courses. If you go to the courses section, there's much more on Iron Condors, a very detailed course there as well. And there's a getting started with options under the start here. So anyways, let's kick things off. Let's get going. And here we go with the shop. I'm going to use shop just because it's a bigger stock. It allows me to manipulate the strikes a little bit easier, and there's many more of them in the future, so it just makes it a lot easier rather than a cheaper stock. So if we set up a kind of a 10 contract Iron Condor here, I've got the 1380s and the 1100s on the put side. I'm going to receive $1.50 credit. This is a short duration according to my recording. Right now, June 4th is 10 days out. Okay, so this is 10 days out. So I've got a 10-day duration Condor. Okay, now what I want you to pay close attention to are these, Delta, Gamma, Theta, Vega. Really, more importantly, the Theta and the Vega. Because when you look at something like this, the Theta versus the Vega, if you have a Vega problem, which is your biggest Greek, which one's your biggest? Because these are your money makers. Those are also your risks. Your biggest Greek is the Vega. So if you have a Vega problem, let's say it's 1 or 2 points, it only takes you a day, even half a day, to make up a Vega issue. So in here, Vega is not a big concern. And price, if you look at your Delta, you got almost a 3. So you don't really care about price moving around because it's pretty much right in the middle. That's your white line. It's kind of moving around right there. But Theta right here is 200. You're making $200 a day. Boom, 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 boom. But if you got a volatility problem, that Theta, it's just way stronger. Now, let's look at another Condor here real quick. So now I'm going to go to June 18th. So the June 18th, if I look at that one, the June 18th is 24 days out until expiration from as I'm recording this video. So June 18th right here. Okay, so look at the Theta and Vega here. Oh, it's getting a little bit closer, right? So now I got a 151 versus a 201. Now the Vega is much bigger. So I've got a kind of a 150 to 200. So they're almost even, you could say, but it'll take a day and some, at least a good day, to make up a volatility problem. Let's say you've got a 3-point volatility problem. So that's 600. How many days? Okay, so 3 times the 200, that's 600. So how many days does it take to make it up with a 150, right? So about 4 days or so, 3-4 days. So that's what you're looking at. It's kind of like a ratio, right? So what's the ratio of 150 to 200? As I go more further duration, here we go with July 16th. And the July 16th here is 52 days out. So now we're going into more of a traditional thing. And here what you'll notice is this line is a bit flatter. So I've got a 214 Vega, still the biggest Greek. Look at the Delta is nearly 0. And then you've got a Theta of about 82. So how many days does it take to make that up, right? So about, what, 2, 3? About a 3 times, because that would be 240. So, but if you've got a 3-point volatility problem, again, that'll be about, let's say, 640 or so. And then how long does it take to make that up? So that's what you're looking at. So notice what's happening is as we go further and further, okay, let's go to a September 17th. Look at that theta now, theta to vega. So I've got a 27 versus 156. So it takes me many more days ratio-wise, okay, to make that up. So 3 times, so I've got 30. How many days does it take to make up a 1-point volatility problem? Okay, probably about 5. Okay, about 5 to 6 days. So you can see the ratio is a big difference. So that's the biggest difference, is that when you go further duration, you become more vega sensitive. So here it's 26 to 155. If I go to July 16th, I've got an 82 to 215. Okay. If I go closer, June 18th, I've got a 151 to 201. So it's almost a 1-to-1 ratio. And then if I go very short duration, my theta is almost twice as big. So you can see theta is 218 versus 123. So it's like theta is 2 times bigger. Here, you're almost neck and neck, very close. And if you were wondering which one that is, June 18th, that is about 24 days out. So maybe a 20-day out would be kind of almost identical. And then what you go with here is July 16th, which is, I think, 52 days out. You can see it takes about 3 days, 2 to 3 days to make up the vega problem, because you're 80 to 215. And then here, what you've got is a 26 theta, because theta is weaker as you go further out, 26 to almost 30 to about a 150. So about 5 days to make it up. And the further you go, let's see if we can go to, let's say, January 2022. Look at that. I've got a 12 theta to 120 vega. So it almost takes me 10 whole days to make up a 1-point volatility problem. Now, your line is much more flatter here, because look at how flat that line is compared to this one, more rounder, even more rounder, even more rounder. There's more curvature to it, but your time decay is really quick. So there's pros and cons to it. So I think the biggest difference here is as you're going into the 40-day Iron Condor or longer, you have to take into account the vega risk, the volatility risk. Most people think it's the same, a 10-day versus why don't I get the fast theta? Well, yeah, if you get the fast theta, you have more price risk. So here's kind of the big pro and con. Okay, so as you go more in this direction, you have price risk, but the advantage is you get theta. Okay, the other way, if you go the other way, you have vega risk, but less price risk. So those are kind of the big trade-offs. So the more you go in duration, you've got a bigger vega risk, but less price risk, because your curve is much nicer. It's smoother, it's flatter. But if you go shorter duration, yeah, you make faster theta or time, but you increase price risk. You got to be tighter for the same spread and that kind of thing. So for the same value of the spread. So that's what I want to share with you in this video. If you want to learn more about option trading, just go to the Traders Fly website. There's some great courses that I have available as well for things like Iron Condors, and definitely check out the free option mini trading course if you're brand new to option trading. So thanks again. Stay tuned for other great videos. Feel free to sign up and grab some of those freebies. Check out more great videos or sign up to the YouTube channel. Thanks again, and I will see you next time.